Welcome back to our channel, where we break down complex financial concepts and turn them into actionable steps you can take today. Have you ever wondered if there's a secret formula to investing success? Is there a way to predict the market's ups and downs? Today, we're diving into a classic that promises to demystify the world of investing, A Random Walk Down Wall Street by Burton G. Malkiel. Buckle up, because this summary is packed with insights that could change the way you think about your money. Have you ever felt overwhelmed by the idea of investing? The stock market can seem like a roller coaster, with unpredictable twists and turns. But what if I told you that there's a strategy that doesn't rely on predicting the future? Intrigued? Let's dive into the world of Burton G. Malkiel and his groundbreaking book, A Random Walk Down Wall Street. First, let's talk about the main idea behind this book. Malkiel's central thesis is that stock prices follow a random walk, meaning their future movements are inherently unpredictable. He argues that trying to beat the market through stock picking or market timing is not only difficult, but often futile. Instead, Malkiel advocates for a more straightforward approach, investing in a diversified portfolio of low-cost index funds. So what exactly is a random walk? Imagine walking through a forest, taking random turns left or right with no predictable pattern. That's how Malkiel describes stock price movements. He supports this theory with extensive research, showing that past stock prices do not reliably predict future prices. This challenges the traditional belief that skilled investors can consistently outperform the market through superior analysis or intuition. One of the most compelling parts of the book is Malkiel's critique of technical analysis. Technical analysis involves studying past market data, primarily price and volume, to forecast future price movements. Malkiel argues that this method is fundamentally flawed because it relies on patterns that may not exist. He likens it to astrologers who see constellations in the stars. We create patterns where none exist. His advice? Don't waste your time trying to predict the market through charts and graphs. Next, Malkiel takes aim at fundamental analysis, which involves evaluating a company's financial statements, management, and market position to estimate its intrinsic value. While he acknowledges that this method has some merit, he points out that it's incredibly challenging to consistently identify undervalued stocks. The reason? Markets are generally efficient, meaning all available information is already reflected in stock prices. By the time you identify a so-called undervalued stock, the market has likely already adjusted its price. Malkiel introduces the concept of the efficient market hypothesis, EMH, which states that it's impossible to consistently achieve higher returns than the overall market because stock prices already incorporate all relevant information. There are three forms of EMH: weak, semi-strong, and strong. The weak form suggests that past price movements can't predict future prices. The semi-strong form asserts that all publicly available information is reflected in stock prices. The strong form claims that even insider information is already priced in. Malkiel leans toward the semi-strong form, arguing that publicly available information is quickly and efficiently incorporated into stock prices, making it hard for average investors to gain an edge. Given this, what's an investor to do? Malkiel's answer is simple: invest in low-cost, diversified index funds. Index funds aim to replicate the performance of a specific market index, like the S&P 500. By investing in an index fund, you're essentially buying a small piece of every company in that index, which provides broad diversification. This reduces risk and aligns your returns with the overall market. One of the book's key takeaways is the importance of keeping investment costs low. High fees and expenses can significantly erode your returns over time. Malkiel highlights the impact of expense ratios, which are the annual fees charged by mutual funds and ETFs. Even a small difference in expense ratios can lead to substantial differences in your investment outcomes over the long term. For example, a fund with a 1% expense ratio might seem insignificant, but over 30 years, it can cost you tens of thousands of dollars in lost returns. Malkiel also emphasizes the importance of asset allocation, which is the process of spreading your investments across different asset classes, such as stocks, bonds, and real estate. The right asset allocation depends on your risk tolerance, time horizon, and financial goals. Younger investors with a longer time horizon can afford to take on more risk with a higher allocation to stocks. In contrast, older investors nearing retirement might prefer a more conservative allocation with a higher proportion of bonds. One of the most practical pieces of advice in the book is the concept of dollar-cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy can help reduce the impact of market volatility and ensure that you're buying more shares when prices are low and fewer shares when prices are high. Over time, this can lead to a lower average cost per share and reduce the risk of making poor investment decisions based on short-term market movements. Malkiel also discusses the importance of rebalancing your portfolio. As the value of your investments fluctuates, your asset allocation can drift away from your target mix. Rebalancing involves periodically buying and selling assets to restore your original allocation. This helps maintain your desired level of risk and ensures that you're not overly exposed to any one asset class. Another important aspect of retirement planning that Malkiel covers is the role of tax-advantaged accounts, such as 401ks and IRAs. These accounts offer significant tax benefits that can help your investments grow more efficiently. For example, contributions to a traditional 401k are tax-deductible, which can reduce your taxable income in the year you make the contribution. The investments then grow tax-deferred until you withdraw them in retirement when you might be in a lower tax bracket. Roth IRAs, on the other hand, are funded with after-tax dollars, but the investments grow tax-free and qualified withdrawals are also tax-free. One of the most engaging parts of A Random Walk Down Wall Street is Malkiel's discussion of behavioral finance. He explains how psychological biases can lead investors to make irrational decisions that hurt their returns. For example, the tendency to follow the crowd, known as herd behavior, can lead to buying high and selling low. Overconfidence can cause investors to overestimate their ability to predict market movements. By being aware of these biases, you can make more rational investment decisions and avoid common pitfalls. Malkiel also addresses the impact of market bubbles and crashes. He explains that bubbles occur when asset prices become significantly overvalued due to irrational exuberance, while crashes happen when the bubble bursts, leading to sharp declines in prices. While it's impossible to predict when these events will occur, maintaining a diversified portfolio and sticking to your long-term investment plan can help you weather these storms. In the book, Malkiel also offers practical advice for dealing with specific life events, such as buying a home, saving for your children's education, and planning for retirement. He emphasizes the importance of having an emergency fund to cover unexpected expenses, which can prevent you from having to sell investments at an inopportune time. In conclusion, A Random Walk Down Wall Street provides a comprehensive, evidence-based guide to investing that challenges conventional wisdom and offers practical, actionable advice. By embracing the principles of diversification, low costs, and long-term investing, you can build a solid foundation for financial success. If you found this summary helpful, don't forget to subscribe to our channel and hit the like button. Share this video with friends and family who could benefit from these lessons. Remember, your financial journey is in your hands, and with the right knowledge and actions, you can achieve the wealth and freedom you desire. Until next time, keep striving for financial success.